By far, one of the biggest reasons that investors do poorly is that they don't know what to expect when it comes to investing. I always say this. I say this a lot of times, but I actually was doing some work on some statistics here and some returns, and I thought I'd share some of these with you. Number one, this is what we'd like to have as investors. You know, a portfolio, let's say if we've got a portfolio like an aggressive one that I outline in my book about the Maddening Crowd. If you take the asset categories in that mix and basically all the stuff you read, how it's put together in the book, the rate of return from 1970 until now is about 13%. A little bit over 13% was the return. Well, let's say if I'm an investor and I invest in this type of a mix and I go, yeah, that's going to be my long-term expected return, 13%. I'm going to be sorely disappointed. Why? Well, because from 1970 until now, the end of 2009 anyway, 93% of the returns on a year-by-year basis were greater than 1% different from that. You know, for example, you might have negative 22% rate of return one year, followed by a 49% rate of return, followed by 16%, followed by 5%. It might be negative 19 a year after that, and negative 9, and positive 52, and positive 20. These are actual returns. So the returns are never 13%. It's one of the things I like to point out to people. Don't expect it. It's not going to happen. But if you look at all the 10-year returns, you know, if you're an investor, if my one-year returns are going to range all over the place, my expected return will almost never happen. My returns will be way up here or way down here. But if I look at my 10-year returns, which incidentally is the time horizon on that particular portfolio, literally if you look at the numbers regarding that, and I did, 84% of the returns, 84% of the 10-year returns were above 10%. Literally only 5 out of the 31 rolling 10-year periods, only 5 of them were the returns under 10%, and none of them were below, like, there was one that was right next to 5%, but that's about as bad as it got. So literally what we can do is we can say that if I have this type of time horizon, that's not a bad mix historically to use. That's a good mix historically to use. But if I'm expecting this every year, I'm going to be sorely disappointed, like I said. My returns will not clock in at or even near that. So next time you're looking at your annual reports or quarterly reports and you've got a down market condition where things aren't going so well, just realize it's kind of like Tennessee weather. Just wait a little while, it'll get better.